Hi everyone. My name is Kier Prince. I am a Emory Rollins alumni board member along with my co-members Elena and Lindsay. We're here today with Maria Carthon from Emory Financial Aid Office to speak with us about student loans. I know that me personally, there have been issues since I left, me learning the repayment journey. And I think that this session is very relevant to us. And I know that we may have a lot of questions in regards to repayments. So this session is geared to us alumni who have ran into some challenges or need a little help or just want to learn a little information so that we can better assess our financial information and move forward and hopefully get our student loans either repaid or forgiven successfully. Maria, you can take it away.
Thank you, Kiera. Yes. So, as Kiera said, I'm here just to kind of help you or guide you along as much as I can. What I don't know, I will certainly try to find out for you, but I want to make this as informal as possible. Feel free to post your questions in the chat, and we'll stop every few minutes or so to respond to those. But again, this is for you to ask your questions, and I will try my best to answer them as best as I can. Okay, so before we get started, I usually ask the attendees to kind of think about what your goals are as it relates to your repayment life, your student loan repayment life. What is it that you're trying to accomplish? Obviously, the end goal is to pay it paid off or pay at least some of it off. But are you trying to pay it off quickly? Are you trying to pay as little as possible and maybe have loans forgiven in the end? Those are things you have to kind of consider when you're thinking about your repayment life. Okay, before we get started, just a quick information about loan servicers. Here are some of the loan servicers that the Department of Education uses to service your loans. Just remember that your loans are not owned by the servicer. The Department of Education is your lender. So the lender is the Department of Education, but these are your servicing agency that you may be working with. I'm sure most of you at this point know that, know who your servicer are, but just in case, this is the information. Okay, understanding some loan transfers. What that means is that from time to time, your loans, your federal student loans may be transferred from one loan servicing agency to another. That doesn't impact you in any way other than who you're going to be dealing with throughout the life of the loan. The terms of your loans will not change and things like that. It's just who you're doing business with, who you're going to be communicating with. That's what's going to change, but nothing else would change. So just be aware that your loans can be transferred basically without notice. Not without notice, but without your input. But you will be notified if your loans are being transferred from one servicer to the other. Quick information, loans, I ask all the time, but this may or may not apply to you. The current interest rates on the loans right now, 5.5 for undergrad loans, graduate loans, 7.05%. That's the unsub, and the graduate plus loans, 8.05%. Okay, and every July 1st, interest rate changes for new loans. The loans that you have are fixed rate loans, so the interest is not going to change. But if you were to acquire new loans, the interest rate will be different than what you see on your screen. Okay, so let's jump into consolidation versus refinancing, because I do get this question a lot. The question generally is, can I consolidate? And those words sometimes are a bit maybe confused. Can I consolidate my loans together? And if so, what are the benefits of consolidating? So the answer is you can combine federal loans into another federal loan, which was considered consolidation, meaning that you're taking or asking your loan servicer to combine all of your federal loans together. And now, instead of the various interest rates that you may have, you will have the weighted average of all of your student loans. Okay, that's That's called consolidation. What you cannot do, well, actually, let me expand on what you can do. What you can also do is you can, if you choose to, I'm not saying I'm encouraging it, I'm just giving you information. What you can also do if you wanted to consolidate, it's actually called refinancing. You can have a private entity such as a SoFi, and there are many others, purchase your federal loans from the Department of Education into uh, a private product. If you were to do that, again, I'm not necessarily encouraging it, but there are reasons why some people choose to do that. Your federal loans, if you decide to do that, your federal loans are no longer federal loans. They're now a private loan with different terms for that loan. Now, some people choose to do that because maybe they can get a lower interest rate on a private loan. And that's perfectly fine if you decide to do that. But just keep in mind, if you do refi your loans, your federal loans, into a private entity, you are giving up some of the benefits, quite actually all of the benefits that goes along with having a federal student loan. But again, there could be reasons, good reasons, why you could or would want to, primarily maybe because you would get a lower interest rate on the private side than you would on federal loans. Okay. What you cannot do is that you cannot do the opposite. You cannot consolidate private loans into a federal loan. The Department of Education will not allow you to do that, will not allow you to consolidate private loans into a federal loan product. Okay, now, of course, let me know if you have any questions about that. One more thing about consolidation, if you do decide to consolidate federal loans together, you can extend the life of the loan depending on how much you owe. And there are also reasons to consolidate federal loans, such as if you had a Parent Plus loan, for instance, or you had some what they call FFELP loans, federal family educational loans, okay, commercial loans. You could consolidate those federal loans, again, like the Parent Plus loan, so that you can take advantage of some of the forgiveness programs. So there are reasons to consolidate. Okay, so some of the questions that I often get are like, what are the repayment plans that I could take, or someone could take advantage of that it does not involve an income-based repayment, an IBR or IDR, income-driven repayment? So the answer is there are actually 5, and I showed 3 on here, but I'll explain it a little bit further. The standard repayment is a repayment plan that's based on a 10-year repayment, 120 payments equaling 10 years. It's a leveled repayment plan. So in other words, if you do nothing at all, if you do not contact your loan servicing agency and say, I want to take advantage of an IDR or any other type of repayment plan, they're going to put you in what's called a standard repayment plan. It's a leveled repayment, meaning that you're paying the same amount every month for 10 years. And then you're done. There is no forgiveness component necessarily attached to that, okay? But it is probably the most aggressive repayment plan. So for those of you who may have the resources to pay a higher payment monthly, and you want to just kind of get rid of the student loans, just kind of once and for all quickly, a standard repayment plan may be the option for you. And there are no prepayment penalties. So if you do decide to say, take advantage of a standard repayment plan, a 10-year repayment plan, but really want to pay it off within 5 years, because maybe, again, you have the resource to do that, you can pay it off without any type of prepayment penalty. Okay, so that's standard. It's a leveled repayment plan for 10 years, 120 payments. Okay, so maybe the standard is not something that you want to consider. You can take advantage of what's called a graduated or an extended graduated. Okay, graduated is kind of what it sounds like. It's a gradual increase, kind of like if you can envision as a stairs, a set of stairs. So every 2 years, your payments would increase using a graduated repayment plan. And these are beneficial. This type of repayment plan is beneficial to those who know that their income is probably going to be a lot more significant, a lot larger in the next, say, 4 or 5 years after going into repayment. But you want to start off with a smaller payment and then gradually increase your payments over the course of 10 years. And there's what's called extended graduated. So graduated by itself is 10 years, very similar to standard, but again, a gradual increase every 2 years. And there's extended graduated, which is 25 years, 300 payments, which is, again, a graduated repayment plan, a gradual increase every 2 years, but extending it for 25 years instead of 10 years. Now, obviously, as you know, the longer you take to repay these loans, the more interest you're accruing over time, right? But again, it is an option for you. And a little bit further down into the presentation, I'm going to just show you a comparison of how much interest you will be assessed by taking advantage of some of these repayment plans over others. There's also what's called extended repayment. Extended repayment is basically what it says. You're asking the servicer to allow you to extend your repayment life over, say, the standard repayment. Remember, standard is 10 years or 120 payment. Extended is a leveled repayment, just like standard, but you're extending it for 25 years. The more interest, of course, the longer you take to repay your loans, the more interest you will accrue on your loans. Okay, so I'll take a quick break right now and see, does anyone have any questions? If not, we'll just keep going.
I don't see any questions in the chat right now.
Okay.
Remember, if you do have a question, please put it in the chat, or when we take our breaks, this is your opportunity to come on and just ask your question.
Okay, thank you. We'll keep going. Again, stop me if you have any questions. Okay, so we talked about repayment plans that are not necessarily looking at how much you earn, just solely the ones that we just discussed are looking at how much you owe. But there are also what's called income-driven repayment plans. So we'll spend most of our time here discussing IDR plans, income-driven repayment plans. Okay. And again, IDR plans are based on your monthly pay or based on your monthly payment amount on how much money you make and your family size. So it's based on how much you make and your family size. And two of them that we're going to spend some time on today is the SAVE plan, or Saving on Valuable Education, which is the newest plan. It used to be the Repay or Revised Pay as You Earn plan. And then we're also going to talk about the Pay as You Earn repayment plan. Okay, income contingent repayment plan, for instance, is kind of it's somewhat outdated, but it still benefits those who have, say, a Parent Plus loan, and you want to have that Parent Plus loan be considered for public service loan forgiveness or other type of forgiveness plans, but you have to consolidate them in order and take advantage of the income contingent repayment plan. But again, we'll spend more time on the on the Save as You Earn, the SAVE, and the Pay plan. Okay, so comparing the Pay as You Earn versus the SAVE plan. Okay, the Pay plan recipients may have to prove hardship versus the SAVE plan. Again, Repay. If you are in the Repay program, Repay recipients are automatically enrolled in the SAVE plan. Okay, just make sure that you're clear on that. The Pay plan offers a typical repayment term of 20 years, but under the SAVE plan is 20 years for undergraduate loans, but 25 years for graduate loans. Okay, under the Pay plan, the payments are capped at 10% of your discretionary income. Now, discretionary income is income that's above the federal poverty level, and we'll talk about that in a minute. But again, discretionary income, 10% of your discretionary income, same as the SAVE plan. So they both use the 10% discretionary income. And then under the pay plan, after 20 years of payments, the balance is forgiven, as I mentioned previously. But under the SAVE plan, after 20 or 25 years of payments, the balance is forgiven. Again, depending on if you have undergraduate loans and graduate loans, or if you have just graduate loans. Here's some more comparisons here. So which loans are eligible? You'll see here that under the pay plan, the direct loans, Pell loans, Perkins loans, if they're consolidated, the Pell and Perkins loans, if they're consolidated. But also, this is probably one of the most significant difference in terms of eligible loans. Under the pay plan, you must be a new borrower. What that means is that you had no outstanding loans on or before October 1st, 2007, which probably most of you did not, and loans had to be dispersed on or after October 1st, 2011. So before October 1st, 2007, no outstanding balance. After October 1st, had to have loans dispersed. Okay, so you had to be what's called a new borrower. Okay, under the SAVE plan, you'll see these are the loans that qualify. The repayment term, again, is 20 years for the pay plan, but under the SAVE plan, again, it's 20 years for undergrad, 25 years for graduate loans. Again, what are the qualifications? Hardship for pay, all borrowers with qualifying federal loans, and the qualifying loans are the ones above. Here's a significant difference as well. What are the payment caps? Meaning, like, what is the maximum amount that you would have to pay under these programs? Under the pay plan, 10% of your discretionary income, no more than the payments for standard 10-year repayment. So in other words, they're going to look to see if, the 10% discretionary income, but you could not qualify if your payments are going to be higher than what the standard repayment plan would be. Versus the SAVE plan, there is no payment cap, meaning that you actually could be paying more than what the standard 10-year repayment plan is. Interest subsidy, the government pays the surplus interest charges on subsidized loans for 3 years. And I'll explain that a little bit more because that's probably a little very tricky. On the SAVE plan, the government pays any extra unpaid monthly interest, so you are not penalized for unpaid interest. I'll show you on the next slide what that actually means. The marriage penalty, they're both the same. If you're filing married filings separately, then you are not required to provide your spouse's information. In other words, your spouse's income is not going to be part of the calculation. If you're filing married filing separately, if you're filing married filing jointly, unfortunately, your spouse's information will be used. Okay. Actually, this again is just the part of this SAVE plan. Talks about how your payments would decrease. It would be less than what it would be under the pay plan because they're using, instead of 150% of the amount over the poverty line, they're using 225%. Okay, so your payments under SAVE would be less than what it would be if you took advantage of the pay plan because of the amount that is being used, the amount that's being calculated. Okay, so that amount would actually be less, but remember, it's for a longer period of time under the SAVE plan versus the pay plan. So you kind of have to ask yourself, the monthly amount, is that more important, or is that it's going to fit more into your budget by having a smaller payment, but potentially for a longer period of time? Or are you considering a slightly higher payment under the pay plan, but potentially for a 5 year shorter period of time?
Maria, we have a question.
Oh,
Someone asked, what constitutes a financial hardship for on the payee plan?
yeah, I mean, it could be several things. It could be that you're under you're not you, one of the main things, of course, could be unemployment, but it could be that your income is such where you are not earning enough to pay your monthly expenses. Um, it could be, yeah, it could be many things. Again, it could most of the time it's that your income based on your family size, you're not earning enough to cover your expenses. That's generally economic hardship, or unemployment, of course, being one. But there could be other things, and there are many that the loan servicer will go over with you. So if you're not really sure if you meet economic hardship, I would just say contact your loan servicer. There are so many things that they look at, and it is really not a high bar, to be perfectly honest with you, to prove that you are that you could meet economic hardship, but you do have to explain to them what your income is, what your debt is, and things like that.
And I just want to add that
Mhm.
part of when you're applying for these particular repayment plans, that is done on their end. So when you do your initial application to enroll in one of these plans, they look at your income, and I think a comparison is probably done with the standard payment plan to see what you would pay, and if that is truly indeed you would be affected by paying the standard versus being in an income driven plan. And so that will really be done at the on the back end, but you can also go to the website and then actually compare by actually putting your income to see. And the program is really, I think that's one thing that they do, the Department of Education, that they do get right, is they'll show you kind of where your payments will be before you even go into it. So you can kind of make that choice under each program, which is better for you.
Yes, that's absolutely right, Kara. Thank you so much. There is a calculator on the Department of Education's website, the studentaid.gov website, that you can, as Kara said, put in all of your information, and you can get a kind of like a side-by-side comparison of what your payments would look like using the various types of repayment plans. So Kara said, you don't have to you won't have to make a decision until you can actually see what it actually looks like. And I do have a few slides down, some kind of comparisons as well, so you'll have an idea. But thank you for that. Some of the upcoming benefits, and again, it is upcoming. It has, I'm just trying to get information as I get information and trying to kind of pass it along. But coming in July of this year, there are some changes that are going to be coming about, at least for now. Hopefully nothing will change. But one of the things that will change, and this again may or may not apply to you, loan payments for undergraduate borrowers will go from 10% to 5% of their discretionary income. So if you have any undergraduate loans, you could actually see a reduction in your payments because it's taking advantage of a lower percentage of your discretionary income that's above the poverty line. Is discretionary. Borrowers with undergraduate and graduate loans will pay a weighted average. So if you have undergrad and graduate loans, you'll pay the weighted average between 5% and 10% of your income based on the loan's original principal balance. So that's good news too for graduate borrowers. If your original principal balance was $12,000 or less, you could actually receive forgiveness for any remaining balance after 10 years of payments, with a maximum repayment period before forgiveness, so increasing. So in other words, if you have $13,000 in original principal balance, instead of 10 years, it could be 11 years. So any additional $1,000 is an additional 1 year. Okay, so just for the example there. And then loan consolidation will count towards forgiveness, because in the past, if you consolidated your loans, sometimes you would actually lose the payments that you've made previously. because it's a loan consolidation is actually, it constitutes like a new loan. So kind of start the clock all over, but coming again in July, at least the information that I have right now, coming in July of this year, 2024, that will not happen. And then also coming in July, you will also receive credit. Credit will automatically apply towards forgiveness for certain periods of deferment. So if you are in a deferment or forbearance status, effective July, you can actually get credit towards loan forgiveness even while you are in those statuses, which is actually fantastic news for some people who are not able to go into repayment, maybe for hardship reasons, maybe you are deferring it for other reasons, but again, credit will automatically apply towards forgiveness if you qualify for certain periods of deferment or forbearances.
Maria, we have two questions from the chat. But before I tell you the two questions,
Sure.
I just want to give a caveat to the SAVE program. Legislation does change, but as of right now, if you're in the payee plan or I believe it's the ICR plan, if you do switch over to that SAVE plan, I believe they're not going to let you back into the payee plan after July 1st. So the borrowers that are currently in the payee plans and the ICR plan, you can remain in there, but after July 1st of 2024, you will not be able to come back to the plan if you do decide to switch over to the SAVE plan. So thinking about that before you make a switch is helpful as well. So understanding that if you're in those two payment plans, once you switch over to SAVE, if you do decide to switch over to SAVE plan, you cannot come back after that switch. But the question,
if you don't mind, I can add something to that here. From what I'm also hearing, to kind of piggyback on that, is that they're also administration, Department of Education is also considering, if you were to switch from one program to the other, that you would have to enter into a standard repayment plan for one payment before they would switch you into another payment. So in other words, they would kind of give you a pause, but you would have to make your payment based on what a standard repayment plan would look like, which could be significant for many people. And then after that, they would switch you. It's all kind of discussions right now, but I don't really know which one's going to stick, but just kind of keep that in mind as well.
The first question was, they're just seeking clarity, but under the SAVE plan, any undergraduate loans will be forgetting at 20 years. And then the remaining is graduate loans, they'll be forgiving at 25. Is that correct? Or is the question saying that if you have a mix of both graduate and undergrad, will they make you carry all the way up to 25 and then forgive? Or will they just drop off? The undergrad will just drop off after 20?
Yeah, it's actually a really good question. So what will happen if you have a mixture of undergrad loans and graduate loans? If you entered repayment on your undergraduate loans, if you had already entered repayment on your undergraduate loans, those will still count towards your payment. So it will actually lessen. Okay, so what happens is if you have undergraduate loans and graduate loans, it actually puts you into a 25-year repayment plan, okay? However, if you've made payments already on your undergraduate loan, then it reduces to 25 years. It's kind of confusing, but because the reg says if you have undergraduate and graduate loans combined, you actually are pushed into the 25-year category. However, if you've made payments on undergraduate loans, then the payments that you've made on your undergraduate loan reduces the 25 years back down to whatever those amounts would be that you've made payments on the undergraduate loans. Hope I answered that question. Do we have another question, Peter?
The other question is, are there any early payment penalties for SAVE or the pay program?
No, there are no early payment penalties. Okay, there are no if you prepay, but you kind of have to ask yourself, if you're prepaying, if you're paying off early, then really is that the goal, because the goal of utilizing the SAVE plan as well as even the paid plan is to pay a lesser amount because your income reflects that lesser amount. So if you're paying more than what you're required to pay under either of those plans, then really are you in the right plan? But to answer, yes, you can pay off early. You can pay it off early. There are no penalties for that. Okay, but the forgiveness component, remember there's a forgiveness component attached to these repayment plans, and you have to satisfy that the terms of that repayment plan. So 20 years, 25 years, whatever the repayment term is, you have to satisfy that. So if you paid off early, one or two things would happen is that you're not going to have any loan amount to forgive, right? So you'd be paying more than what you were required to pay, but you can do that. It's just that it may not be beneficial to you to do that.
And we had one more question. Is there also a way to see what your new payments would be before switching? For instance, if I apply to save and I'm accepted, am I automatically transfer or can I make a decision on what to do? Like I said, that before you apply for the repayment plan, asking them, you can go on to the calculator. The calculator is kind of accurate. If you get the actual information from your tax return that they're going to use to set your payments, they use the previous year's tax return to set your payments for the year. So if you actually use that figure and put that figure in, that's correct. It's pretty accurate on
Yes.
Giving you each payment that you would pay for each repayment plan. But I will also let Maria answer this as well.
Yeah, that's absolutely right. It's going to be as accurate as the information that you put in there, right? So if you put in accurate information, it's going to give you an accurate outcome. Okay, it's going to show you exactly what your payments would look like under the various programs, as long as the information that you're putting in is accurate. Yeah, and it's actually a really good tool. And to answer your question, no, you don't. Yes, you can look to see what your repayments plans would look like before making a decision using those calculators.
And just to clarify, when we went over the cap for pay and save, someone asked a question about how to determine a financial hardship. So just to clarify, I think one of the benefits of pay that save doesn't have is the cap. And so when you're thinking about that and thinking about the longevity of you being in there, having loan forgiveness at 20 years versus 25, under pay plan, if your income gets too high, there's a ceiling on payment that you would make in that plan. It's never going to go past that 10-year standard repayment plan.
Right.
So even if they say, yeah, you make a lot of income now, you're not in a technically financial hardship, it's going to be set at whatever the 10-year plan was. It's never going to go higher than that. Versus if you were in the save, it could potentially go higher than what was set in the standard repayment plan.
Absolutely right. That's exactly right. So you kind of have to decide what's important to you in terms of paying less potentially using save, or well, actually it could vary, or the length of time to repay. But yes, all that information that Kara just mentioned is actually right.
And we had a couple more. If you have been in another IDR plan prior to save existing, do those years of payment count towards the 20 or 25 years for forgiveness and save?
Yeah, I'm sorry. So the question was, if you were in another IDR plan, will it count towards the save?
Yes, if you were in another IDR plan prior to save existing, before people were given an opportunity to switch into it, do the years that you've made payments count towards the 20 or 25 years for forgiveness?
Yeah, it would, but it would be a recalculation based on the saves, the terms of save. But yes, the payments can count and will count towards the 20, 25 years of save.
And I think we had a piggyback question off the calculator. So for this year, like for example, currently when I recertified, I didn't file my 2023 taxes this year. So they had to use the 2022 taxes. That's what's on file from the IRS. Of course, when I recertify for next year, for 20 in 2025, they're of course going to use the 2023 taxes because the tax season doesn't end or the tax
Right,
deadline isn't until April 15th. So they have to use the whatever is on the file, which is the latest, which will be the 2022 at this
right,
point, doing recertification.
right, exactly. Whatever the most recent tax year is, full tax year is what they're going to utilize. So yes, 2023 will be used for the next certification instead of 2022.
And that's it for the questions right
Okay,
now.
great question. Thank you so much. All right, so oh, this is just a poverty guideline. So I get this question a lot, like what does poverty guideline look? Of course, you can just get that from the IRS or different places on the HHS site. This is what the HHS poverty guidelines look like for 2024, meaning that anything above the poverty line based on your household size and income is considered discretionary, and that is the income that is used in the calculation for these IDR plans. Just kind of recap some of the things that we talked about, like what to consider when you're kind of deciding which one to use. Save offer lower payments, calculating payments based on 225% of the federal poverty standard instead of 150% for paid plans. Pay only subsidizes unpaid interest for the first 3 years of the loan, while Save lasts for the entire life of the loan. Let me explain that a little bit. I'll give you an example, and I thought I had a slide I made, but we'll talk about it. For instance, if you are required to make, say, for easy calculation in my head, let's just say you're required to make, actually, let's say you have an interest accruing of $50 a month, right? But your payments are only $30 a month. There is a negative amortization, right? There's $20 that's still, your payments are not paying the full interest of $50. So if your payments are $30, but your interest is $50, there's $20 that's still not met, right, by your payment. So that's what they're talking about. So for under the pay program, only pay only subsidize unpaid interest, the $20, that's the unpaid interest for the first 3 years of the loan, while Save lasts the entire life of the loan. Okay, so that $20 unpaid interest under the Save plan is subsidized by the Department of Education, by the federal government for the entire life of the loan, as opposed to the pay plan, that $20, that unmet $20 in that scenario that I just mentioned, is only subsidized for 3 years. So that means that you, under the Save plan, less interest will be accruing on your loans because the $20 that's not being paid by you is but being subsidized by the federal government. Okay. All right. So for both the Save and Pay plans, borrowers who file taxes separately do not have to include their spouse's income for their loans. That's only if you file separately. While Pay plan has a monthly cap on its payments, Save does not. So you could end up paying more than the standard 10-year plan amount if your income increases and your debt becomes lower. With the Save plan, graduate debt is not forgiven until 25 years compared to the 20 years associated with the Pay plan. Again, that's just kind of recap of some of the things that we talked about. Those are the things that you must consider when you're kind of deciding which one would be best for you.
And I just want to, I think there's some issues with, I think someone may have mentioned they were married. So as of right now, legislation hasn't occurred for, we have people like, we understand, well, I guess the Department of Education is trying to understand, but we understand quicker than the Department of Education. But things happen, like people get divorced. The issue comes that when you were filing jointly with your spouse, now it's time to come dividing, figuring out how much payment you're going to make now that you divorced. There's been issues where people couldn't have their payments reapportioned properly because of they had a combined income in marriage. So I think that they did say they're working. I have never, I wouldn't say never, but I haven't seen any legislation in regards to how they're gonna help divorcees separate their payments from there.
Yeah,
So that's
actually,
something to really think about as well.
yeah, yeah. I actually was trying to catch up on that very same issue myself over the last few weeks. And yes, they are working on that. So their portion is that they are, of course, whatever percentage of the income that you earn, let's just say you earned 60% of the income in that marriage, in that return, then of course they would calculate it where you would pay the same percentage, utilizing the calculator. It's just really confusing, but yes, from my understanding, they are working on that. The Department of Ed is working on that, because that is a real issue. And I'm not 100% sure where they are on that yet. Oh, this is just the example of what I spoke to you about the interest benefits uh, for this under the SAVE plan versus the pay plan. Okay, the example that I gave you about the interest, the negative amortization amount, the $20 unpaid, and how that looks on the SAVE plan versus the pay plan. Okay, this is really just a quick side by side for you to look at, and this will be available to you if you utilize the calculator. I just threw this into a calculator myself, and just to kind of get an idea. But under the standard repayment plan, giving the scenario on the right, meaning that you owe, and again, may not apply to all of you, but this is just a typical scenario. If you had $68,000 in student loan debt with an average interest of about 7%, with an annual income of 50,000, with a household size of one, with the potential to have your salary increase by 5% every year. Okay, what does your payment look like? So I wanted to start off with the standard, because again, standard is not looking at how much you earn. It's really just looking at how much you owe and what that payments would look like. So under the standard, given that same scenario, your payments would be about $756 a month. Remember, standard is a level payment. So the amount that you're starting off with in the beginning is the same amount you're going to pay through the end, $756 a month. But you'll see you started out with $68,000 and you ended up paying a total of $90,713 over 10 years, 120 months. So you paid about $22,000 or so in interest versus a graduated repayment plan. Again, same scenario. You would have your monthly payments would have started out at about $432 a month, but will go up to about $1,297 a month, because remember, graduated is an increase over the life of the loan. But see, you will pay about $6,000 more in interest using the graduated repayment plan. The extended fix, again, is very similar to the standard, but you will see here, again, it's 300 months, which is 20 months, which is 25 years. You will pay a total of $131,000 in total by the time you're finished if you took advantage of an extended fixed repayment plan. Remember, you started out with $68,000 in that scenario, so you're doubled your if you took advantage of the extended fix, meaning the level payment for a longer period of time. Extended graduated, you'll see there, you'll pay even more because you're only paying a smaller amount in the beginning, so you're really covering interest for the most part and not paying much on the principal. And so therefore you will pay even more taking advantage of an extended graduated repayment plan. Some of these, again, I just did a revised pay, but I know that's changed a little bit. I didn't throw in the save, which I should have, but I didn't throw in the save. But you'll see here that the revised pay is there. Save will save you a little bit even more monthly. But under the revised pay and pay as you earn and things like that, you will see that your monthly payments would be substantially less because it's taken into consideration your income and household size. And so your payments would be about $266 a month, given that scenario. Goes up to about $460 a month, because again, we're making the assumption that your salary is going to increase over time as well. Again, this is just a quick throw information into the calculator based on a scenario, and it gives you an idea of what it's going to look like. Now, again, the more accurate the information that you put into these calculators, the more accurate these plans are going to show. Okay. Does anyone have any questions about this chart? Again, it's just a scenario that I use. It's not going to apply to specifically to you or to any one of you, but it's to give you an idea of what the calculator is going to show you.
And the calculator should be used before you apply for the repayment plan. Don't, apply for the plan and then decide, hey, let me go look at a calculator, and then you figure something was better for you. It's better on your end to do the, I guess, hard work or the calculations before, and then go into a payment plan, then trying to reverse it, because the services do take a while to fix stuff, and you don't want to be in a forbearance that's not counting towards loan forgiveness. You don't want to be placed or have them placed in your accounts in administrative forbearance until they correct issues. You just want to kind of address that on the front end before. So knowing which payment you want to go into before you submit the form, because it's going to take them at least 90 days to process the form. They are quicker, but they normally publicly ask that people give them 90 days to process the form. So
perfect. Yes, thank you. We have about 10 more minutes or so. So let's move on to tax implications on forgiven loans. So under the tax code law, student loan forgiveness is taxable under normal circumstances. And I'll explain what that means in exception 1 and exception 2. Student loan forgiveness may be taxable at the state level. So even though it may be forgiven, or even though you may not have a tax liability on the federal level, on the state level, the state can determine how, or the states can decide if they want to impose their debt cancellation tax instead of aligning it with their federal exemption. Okay, so don't forget about that. Exception number 1, student loans forgiven under public service loan forgiveness, PSLF, are not considered income for tax purposes, again, for federal, and will not be taxed by the federal government. There will not be a federal tax liability, in other words, if you take advantage of public service loan forgiveness, which we will go into for about 5 minutes. However, again, your state may tax you under public service, even under public service loan forgiveness, because it's not, there's no tax liability on the federal level. However, your state, depending on the state that you live in, may still tax you. Exception number 2, loans discharged between January 1st, 2021 and December 31st, 2025 will also be exempt from federal income taxes. Only applies to those with income-driven repayment plans. This is as part of the American Rescue Plan Act. Okay, so there is a short window of time where loans, even if you were not under public service loan forgiveness, discharge loans from January 1st, 2021 through December 31st, 2025 will be exempt from federal income taxes. Okay. Any questions about that? So we're going to talk briefly about the public service loan forgiveness plan. Okay, so public service loan forgiveness. It applies to those individuals who worked at a qualifying organization. What that means is that you have to work at a federal, state, or local government entity or a 501c3 nonprofit, okay? 501c3 is an IRS tax code. Not all nonprofits are 501c3. So again, those are the 4: federal, state, or local government. It's not what you do at your job necessarily, it's who you work for. Federal, state, or local government entity, or a 501c3. You have to be employed full-time as well. Okay, and you have to make payments under a qualifying repayment plans, such as a 10-year standard or an IDR plan. Okay. So those things, and you have to make payments on time. So once you've satisfied those requirements, after 120 on-time payments under those other requirements, you can actually have the balance of your loans forgiven through public service. And one of the beauties of public service is that, again, if whatever is forgiven at the end of that term, it doesn't have a tax liability attached to it, a federal tax liability attached to it. Okay. And it's a shorter period than the 20 years, 25 years that we were talking about earlier. This is only, and I say only, 10 years could be a long time no matter how you look at it, but it's a lot less than 20 years or 25 years. But you can if you make 120 on-time payments, then you could actually have the balance of your loans forgiven. Okay. Again, you have to meet those other criteria as well. Any questions about public service loan forgiveness? Because I can go on for a while about public service loan forgiveness, but just kind of keeping it short. Any questions about public service loan forgiveness? No. One thing that's really important, and it's on this slide, is make sure that you have your employer complete the public service loan forgiveness employment certification form annually. Have them complete. You complete your section, have your employer complete their section, and then you send it back to your loan servicer and keep a copy, of course. Of course, if you're going to email it, you'll have that copy for your record, or upload it into the portal. You'll have a copy for your record. Just make sure that you do this on an annual basis. This way you know that your loan servicer is aware that you are working at a qualifying organization full-time, and that there will be no problems at the end of that life, that 120 payments, that there'll be no question about where you were working. You can work for 2 or 3 different qualifying organizations throughout the 10 years. It doesn't matter, like, if you stop one and start another, as long as they still meet the criteria, federal, state, or local government entity, or 501c3. Okay. And again, you have to be employed full-time. Any questions about that?
I don't think it's an actual question about that, but someone said if we are trying to find someone who can walk us through our specific circumstances, do you have suggestions? My experience has been that accountants and financial advisors do not know much more about these options than I do. I think alumni could always go back to Emory Financial Aid for assistance as well.
Yeah.
And older alumni maybe I learned a lot of these things from people that have gotten their loans forgiven. For instance, the slide right now talks about the certification form. It's more, how the saying, a wise person will learn from their mistakes, but a wiser person will learn from somebody else's mistakes. When the first set of people came up for forgiveness, which means the people in 2007 that came up for forgiveness in 2017, were coming up and putting in their form for forgiveness, a lot of them had issues, mainly because this form was missing. And they tried to do this form at the end. And so the Department of Education was going back looking at employment and said, hey, you don't have the 120 payments. So that's where I think this is coming from years of experience. Me being on the job, asking older people that have been in the payment more than me and that know a little more about it, they were able to steer me. And then actually coming back periodically to find the Office of Financial Aid as an alumni, if you have any questions, so that way we could kind of steer you into or at least help you figure something out or get a plan or something that will work for your type of situation.
Yeah, thank you. And I am available. And I do speak to those alumni that have been away for 10, 20 years. I actually have spoken to a few of the doctors at Emory that are working at Emory and over the last few years as well. So feel free to reach out to me. I have my contact information the end of this. So you can contact me. You are welcome to do so whenever you have time. So you do have someone here. And if I'm not able to address your questions, I will try my best to either find the answer for you or refer you to somewhere else that could answer it, best answer it for you. But you are always welcome to contact me. If we don't mind, let's move on really quickly about student loan interest deduction. I won't even go into it too much, but just know that you can deduct a part of your the interest that you're paying annually. You can actually deduct up to $2,500 of that. And here are the criteria, depending if you're single, head of household, qualified, surviving spouse, or if you're married, filing jointly. Here's where it starts phasing out. So if you earn if you earn more than $90,000 as a single person, then you cannot claim the deduction. If you earn more than $185,000 as a married family, you cannot claim a deduction at that point, but there are other times that you can claim the interest. Okay, and these slides are available to you. You can definitely contact, I think, Michelle or even Kier, and these slides can be sent to you if you choose to have it. And here's my contact information. Again, feel free to reach out to me via email if you want to set up an appointment with me, a virtual appointment. Feel free to send me a quick email and just let me know what you would like. And I think that is it for me. Any more
Someone
questions?
asked, will this recording be available? And I think the answer is yes. We plan to make this available on our website.
Perfect. Well, if there are no more questions, again, thank you all so much for your time. I know it can be very confusing. It changes. It seems like, these things are changing almost daily. I will do my best, and I try my best to kind of keep up with some of the things that are changing. And but again, what I don't know, I will try my best to find out. And if not, I will try to at least refer you to someone. Again, thank you so much for your time.